I put together the investment challenge as a little exercise to help every investor understand what to look for in their portfolios. I got this out of the whole Pepsi Coca-Cola challenge. And I'm challenging you when you go through this to say, well, this is the kind of portfolio I would want. And then at the same time, you can send us your portfolio and we'll do a free analysis for you to take a look at it. But these are the metrics, and you're going to see this all the time in everything that I do, because this is how you should properly evaluate a portfolio. And you want to know if the rate of return that you're expected to make on this collection of investments that you have in your portfolio, what is that rate of return, and what is the real rate of return after you subtract out your purchasing power, expenses, taxes, and your cost of living increase. Okay, that's a really important thing. You want to know if you're getting or expected to get from that portfolio the rate of return that you want. You want to know the volatility, standard deviation. People in our industry use this statistic wrong. It always needs to be measured in relationship to a rate of return. You can't just say I have a standard deviation of 5 and that's good, or a standard deviation of 20 and that's bad. Can't do it. It always has to be in relationship to your rate of return. Variance drag phantom tax is a statistic that takes care of that measure. All you really need to know in a portfolio is what is your VDPT, and you want it to be 0.8 or lower. If we do an analysis for you, and you'll see some portfolios in a moment that really express how important this is, and you find that your portfolio is 1.5 or higher, you need to change that portfolio immediately. Other things, very quickly in evaluating a portfolio, what is the probability of any loss in the next 12 months? You'd like to know that. You'd also like to know how much money is at risk and what is the range. And the way to look at upper and lower is this. You have just as good a chance getting this return as you do getting this return over the next 12 months. And I'll show you what I mean by that in a moment. So in the investment challenge, and you do this online, I keep the title of the index or the portfolio private until we click the button show. But on this PowerPoint presentation, I'm just going to show you that over this time period, going back over a 12-month period, and this goes back 12 years, you will see that the historical return of the S&P 500 is almost 9 with a standard deviation of 14. Well, all you have to do is look at your VDPT and see that that portfolio is broken. You have way too high a probability of a loss in the next 12 months, 26%. And on $3 million, if you happen to have had that, and you can calculate it based on whatever number you have, if you had put it in the S&P 500, the amount of money at risk based on historical data is $700,000. But here's the key. You have just as good a chance of losing 20% in the next 12 months as you do making about 40%. That's too big a range. You want to narrow that range. Now, everyone says that Warren Buffett's the greatest investor of all time. And I always laugh at what a great marketer Warren Buffett is. And he has a lot of money, but the reason he has a lot of money is because he's stayed fully invested. It's not because he is so superior to others. And all you have to do is look at the variance drag phantom tax. Look at his range. If I came to you and said, I have a manager where the performance has been plus 44 and minus 24, that's the range over a 12-month period based on historical data. In this case, it was the last 10 years. You probably wouldn't want that manager, because I couldn't tell you what it's going to be in the future. I can just show you what it's been. And as we go through this, you'll see the same process. Now, here is a typical retail portfolio. And if you're a retail investor, meaning you're an individual investor, this is how that portfolio is broken down, 5.42% rate of return, standard deviation 15. A horrible portfolio. But this is what most people have. That's why it's important for you to have an analysis done. Now here's a manager, D.E. Shaw Oculus. This is a great manager. All right, D.E. Shaw, look at their numbers. Variance drag phantom tax of 0.58. You have just as good a chance, based on historical data, of returning 23.5% over the next 12 months as you do losing 1.77. That's the range. This is how you look at things. Here's the international market. And then here are 4 institutional funds. And by the way, we have access to all of these. So again, I'm showing this to you because you might have an interest in having us take a look. Now, I'm stopping at Fisher. Fisher does a great job of marketing. You see their ads everywhere. But it does a horrible job of managing money. Now, these numbers are about 6 months old, but you get the general idea. Look how much risk Fisher takes. And if you ask Fisher to give you their historical returns, they won't do it. Just won't do it. I was able to get them from a client who had some money with them. Do your own, and let's get your own analysis done if you want. Just wanted you to see, and then here is my favorite investor, which we have money with, which is Izzy Erlinger with Millennium Fund. And then here's a separately managed account. So that's the investment challenge, and I'm challenging you that if you want to know your numbers, send them to us. Give us a call at 972-865-2223, or just email us and we'll get a hold of you. Thanks.